let's check in on oil now. We saw prices ticked higher on Wednesday on expectations that U.S. crude inventories are falling and, of course, signs that oil producers will stick to the agreed output cuts. Now, global benchmark Brent crude futures were up 10 cents to $55.57 a barrel. OPEC members Kuwait lifted expectations that producers will comply with a deal to reduce oversupply after its state-owned oil producer said that it will cut output in the first quarter. Now, members of the Organization of the Petroleum Exporting Countries agreed in November for their first output cut since 2008 in an attempt to stabilize oil prices. And indeed, it has been a rough year for oil prices. Earlier on, I spoke to Dolakbo Oni, he's the head of energy research at EcoBank Group, and I asked him how optimistic he is that OPEC's deal will stay intact.
Indications from the market already show that we're likely to see OPEC actually stick to that agreement. I mean, some of the OPEC countries, such as Kuwait, have already started indicating to their customers that, look, we're going to be reducing our volumes. Kuwait has actually shut down a few wells. Some non-OPEC countries which joined the agreement as well, such as Oman, Bahrain, I mean, they've also started showing some indications of reducing their volumes as well. But the key indication I think the market wants to see is from the main OPEC heavy eaters. I'm talking about the people who are actually meant to make very heavy cuts. Countries like Saudi Arabia, who is supposed to make almost 500,000 barrel per day cuts. Countries like UAE, who have to cut close to another 200. Iraq, UAE as well. Those countries, they have to make quite a significant amount of cuts. So we're expecting to see indications that they will be making their own cuts, as well as Russia, which is a non-OPEC country, but has indicated that it wants to cut 300,000 barrels per day. So once we see once we have some clarity regarding those countries, I think the market will react even more positively.
Well, Dolakbo, let's talk a little bit more about that. We know OPEC's deal, it should mean that the global crude oil glut will come down over the next 6 months. However, given the fact that there are some wild cards, you mentioned some, such as, of course, the U.S. industry becoming more productive, Nigeria and Libya being exempt and ramping up production, how will they play into the oil market and, of course, prices this year?
Thank you. Now, I think that's why there's going to be some significant volatility in the market because I mean, in the first quarter of this year, we expect the OPEC decision to drive prices positively. But as we start to enter the second quarter of this year, I think we'll start to see some of the reaction to that high price. We'll start to see some of the reaction from U.S. shale producers who will now be in profit because, again, once we start to see $55 oil, $57, $58, $60 oil in the market, shale becomes attractive, it becomes profitable, and I expect a lot of shale companies to respond by moving to site and starting production. There are also a lot of other countries, even outside the ones you've mentioned. I mean, countries like Ghana, even as small as Ghana is, Ghana alone this year could contribute somewhere in the region of another 150,000 barrels per day to production. We have countries like Congo. Congo as well is planning to bring on stream a lot production from their Moho North field. And just Africa as a whole could contribute a significant amount of addition to OPEC production. Libya is another wild card. South Sudan has also indicated that, look, we were at 160 thereabout for most of last year. We want to ramp up to 200. So that's an additional 40,000 barrels per day. So there could be some non-OPEC supply growth, which I think will reduce or to some extent moderate the rate at which prices are able to rise, or to some extent also ensure that there's still a bit of a gap in the market, which will ensure that prices don't rise too high. So we could be looking at prices trading within a significant range, but as high as $60, $63 oil, but then they could easily come sharply down as well to the 50s, the low 50s.